What did you make of his latest comments and a pushback seemingly against the market action?
I think we're going to see more of it. I think what you see with the Fed is, they've agreed to do more measured rate hikes, but as they close in on a terminal rate, but they still think that terminal rate, the peak in short-term rates, is higher than they did just a few months ago. And they're going to stick to that kind of language for some time. I think we're going to also see, when we see the PCE index, because of that weird medical cost deceleration in the CPI, the PCE index, which is a day before the Fed meets in December, that when that's released, it's going to show a little hotter core CPI, and the Fed's going to feel pretty justified about continuing to raise rates, although at a 50 basis point pace instead of a 75 basis point pace. And the Fed also doesn't like to see financial market conditions easing right now when they're still trying to tighten. I know that sounds strange, but the bottom line is this is undoing much of the forward guidance that the Fed has worked so hard to establish.
Feels like that summer rally on repeat, and I think Governor Waller alluded to the problems that come about from that. Can we put some numbers just on the SEP that might come out in the middle of December? In fact, it will come out in the middle of December. Can we put some numbers on that, Diane? We saw the SEP and the dot for 2023 move from 380 to 460. I thought that was a major jump. It was a big jump. Are you expecting something similar in the December meeting? 460 and to what?
Well, we did have 6 participants at that meeting that had 5% as the high end of that range. And so I would expect to see those 6 participants to move above 5%, and we could see that SEP, the high end of that rate, move slightly above 5% as well. Our expectation now is that the high end of the range is 5.25%, which is 5.125 in the middle of the target range. But I think that's important to remember is that we already had 6 participants at the meeting in September looking to go higher than what the SEP was telling us.
Diane, you mentioned the medical costs, and I don't want to get too far in the weeds, but there was a glitch or a strange confluence of numbers in the latest CPI report. If you back out that healthcare component, what does CPI look like?
Well, the CPI, certainly the underlying inflation numbers look like they're beginning to peak, which is the good news. And I'm actually much more optimistic that we're going to see a disorderly or a welcome sort of deceleration in shelter costs as we get into 2023 much more quickly than the Federal Reserve expects. That said, this is still a number that's too hot for the Fed and not low enough for the Fed to feel like, the war is over. And I think that's very important, that the Fed still feels like they still have to go higher on rates to cool inflation. And it's still too hot of an inflation rate for them to stop thinking about the pain that might accompany it, which is a rise in the unemployment rate.
We were just talking with Jerome Schneider of PIMCO about how this feels like it could be a prolonged downturn. Even if it's shallow, it's going to last a long time. Do you adhere to that kind of view that perhaps the worst case scenario of a severe downturn seems taken off the table a little bit more, but that it could be a very long time before we see meaningful growth at levels that we'd seen over the past decade?
I think it's going to be every recession is different. Our own expectations are for a moderate recession of a couple of quarters without a robust rebound in the second half of 2023, and then really gaining momentum in the end of 2024. So as a prolonged period of weakness, that is what we are seeing. That said, we're only talking about a high in the unemployment rate nipping close to 6%. That is really low for an unemployment rate for a recession. There's a lot of reasons for that, none the least of which is the aging of the population and the loss of participation by those over 65. Those are going to be holding the participation rate down and the overall unemployment rate down. But this is a very different kind of recession, disproportionately hitting housing, some spillover into consumer spending. Business investment will be hit, but unevenly. We've got the ramp up of electric battery plants going on. We've got subsidies for chip plants going on. Those are ramping up much more quickly than the infrastructure spending bill, which was passed sooner. And that's not going to hit until we get into 2024 and 2025.
And Diane, just out of interest, if the Democrats hold on to the House, and they may well do, I've got no idea what happens here. Everyone's still talking about gridlock, but ultimately things have shifted the other way more recently. Would that change your outlook at all?
I think the biggest change in the outlook is the risks of, battle over the debt ceiling and what that would mean at a time when the Fed's still raising rates. We already had the debacle of 2011 and the debt ceiling debate back then. To take that off the table, I think, is good news. Now, whether or not it means more stimulus or more stimulus if we hit a downturn, I still think that we're limited in fiscal space. So I'm not sure that it actually means more stimulus out there. It certainly, I don't think they're going to have an easy path to any kind of changes in policy, which is a bit unfortunate because we need to make some major decisions on policy that I believe need to be bipartisan in scope. And I don't see that, no matter what the outcome is, either way.